Let's take a final look at the markets this morning. Been watching the futures, and you'll see right now that we are still looking at the futures, well, yeah, in the red at this point. Dow futures indicated off by about 165 points. Joining us right now is Jim DeMare. He is Bank of America's president of global markets. This is his trading floor behind us. So, Jim, first of all, thank you for hosting us here today and for having the troops in, working all through the morning.
Thank you.
Let's talk a little bit about the markets and what you're seeing. You all have 66.66 as your price target for the S&P 500 next year. Easy to remember.
Yes.
It's about 10% up from where it is right now.
Yes.
Why 10% next year? What do you see happening?
Yeah, I think, you've heard from Savita recently, and I think Brian was mentioning it this morning. Savita's constructive on earnings growth coming in for next year. Michael Hartnett, strategist for us as well. He thinks we get there. He thinks we get there sooner. Savita thinks it's an end-of-year target. Michael thinks we get there in the first quarter. And as you can see, divergence of opinions even inside the firm. Yeah.
What do you think, just based on what you see from all the activity here behind us, what you're watching?
Yeah, it's been super interesting. We had the bump post the election, which I think was just a clearing of some uncertainty out in the marketplace. And there's revived enthusiasm, I think, both from investors. You've seen it, and you've also seen it from surveys for CEOs of both large and small companies. So I think that's a very good support base for a good year. In 2025, there's some obviously material and serious topics that people have concerns about, whether it be tariffs, taxes, immigration, all having large impacts on the economy. And I think that's where, you have some extreme optimism and some extreme, pessimism. And I think for the first half of the year, there's a little bit more of a lean towards optimism.
Just in terms of what to expect from the Fed tomorrow, if we get our 25 basis points that the market's expecting, if the Fed then slows down, how does that impact things for next year? If we're no longer in a steep rate cutting cycle, but maybe we're not raising rates anytime soon?
I think that's the base case now. I think most Wall Street firms have adjusted down, which is a material change from where we were. If you go back to a year ago,
adjusted down the number of cuts expected for next year.
The number of cuts. We were, depending on which Wall Street analysts you were speaking to, even this time last year, expected cuts were anywhere from 150 to 200 basis points over a 12 to 18-month period. So I think the concerns about a hard landing, I was thinking about it this morning, the discussion hard landing, soft landing, no landing doesn't seem to be as prevalent as it was, just 12 months ago. So I think the Fed policy, it's obviously clearly important. Monetary policies has a big influence on the markets. But as you've talked about on the show in the past, fiscal policy also is a large driver. And I think we've had that push and pull for the better part of 2 to 3 years. And, we'll find more soon as far as how that policy will remain the same or what tweaks we will see to it.
What's your biggest concern? Obviously, you're optimistic. What's the biggest thing you worry about?
I worry about a lot of things every day. I think my real job is to think about what risks that are out there. One of the more difficult things to anticipate, but something we always look at in the markets, liquidity gaps can be very disruptive. And they can also cause a great deal of disruption outside of where that liquidity gap occurred. We've seen it, it was a year ago in the UK gilt market, with pensions. And we've seen, it snowball. We always seem to find a liquidity gap. So the thing is to be prepared for it, to make sure that we're in a good position and make sure clients are anticipating.